All right. Good morning, everyone. It's 8 a.m., December 24th from beautiful, snowy Connecticut. We had a light dusting of snow last night. And if you are of the Christmas persuasion, as many of us are, it's nice to see. If you're in Florida, it's just boring good weather. You need the seasons to live, right? Um, anyway, it's 8:01 now, and gold is, well, you're not, if you're looking at your screen, I'll fix this for you so we can start with gold. I was just doing a little assessment of the S&P. Uh, let me change my map here. You have my permission to start doing the over unders on the amount of times I say all right, let's start with gold because that is where it's at. That's the only market that matters. You're looking at a 5-minute chart in gold. Why don't we do this? All right, my computer's a little faster today. Uh, my kids haven't been playing on it. All right, last night I will do the price action. Okay, last night, if you remember, if you tuned in about 2 months ago or a month and a half ago, I was noticing a buy order that would come in. Let's go to a 30-minute chart so we don't have to stretch our eyes so much. All right, so here's the 24th. Now, if you were a time series algorithm, well, actually, we'll get to that detail in a second. Let's just end this. On the 24th at 3 a.m., between 3 and 4 a.m., there's your biggest green bar. Someone comes in at 3, between 3 and 3:30, I should say, actually. It's a 30-minute bar, and buys. Now, and it makes the high close to 1269, 1260. And this is spot. This is cash. And why do I keep doing this? I keep doing this because gold's not a United States commodity, folks. It's a global product. All right. And you're going to learn or you're going to drop out. I would prefer that you learn. But we always talk about gold futures here for trading. But use gold spot because the world trades gold from spot. They don't trade futures. You trade stocks or you trade stock futures. I trade gold. I may trade express it in gold futures, but I trade gold. Okay, so arrogance aside, the reason this is important is because most gold flows through London, and London looks at this price, and it does affect my work. Anyway, so the high in spot gold was 1265.33. So take your pencils out today, and the high was 12 in futures, 1268.60. So the spread between spot gold and February futures is approximately $3.30. It's a little bit more than that, 350, close to 4 almost, depending on where you are during the day. But those of you who are familiar with trading indices, talk about fair value. So you can look at it like as a fair value spread, cash to futures. We call it an EFP in the market, but I've gone through this before, but I'm going through this part again. There had been a buyer coming in between 12 and 3, and there was a buy order. And uh, this is also applicable in stocks too. But there has been a buy order around 3 o'clock coming in every day. Not every day, but 3 out of 5 days, it would be obvious that there was more buying than selling. But here we have it again coming at 3 a.m. So is it a buy order or is it a liquidity time? And I would say it's a buy order because of how it started. It started on the lows. Uh, doesn't mean it can't change. But we made the highs then post that time frame. This actually could be an algo, which I think is odd because it's actually a deep time for the market to have algos trading like that. And then the market sells off, and here we are climbing higher. So those of you looking at a 30-minute chart and are technicians, you could look at this thing here and say this is a bear trend with a bull flag, and it gets above a certain level, a bear flag. If it gets above a certain level, it negates it. Or you can say bull trend, bull flag, and then the possibility of a break higher. So you can either be going with a trend or you can be fading this. But if you're a technician, right, I'm speaking as an amateur technician, I would say at the very simplest level, you could say this is a bull move, this is a bear flag, and this is possibly a break higher. But you won't know until you look at the shorter term, which is ignoring all this move and just looking at this and saying bear move, bear trend, bear flag, but above a certain level, it might be two-thirds of this body becomes negated. So maybe you want to be flat here and look higher. But we'll look at the technicals in a second. In fact, let's look at those now because I have some editorial stuff to talk about today. Where are those technicals? Okay. Well, and we'll get to the news obviously after a long weekend. Uh, Certainly not a bad idea to figure out what's going on and why it's going on. Okay, let's make this a little smaller and keep our eyes on the market. Okay, Michael Moore, get long above 1270.30. This is Feb futures, guys. So that would be what you're focused on here. For break above 1270.30 and back below, you frequently see these when we're at the end of technical moves. So I'll say look for profit taking. This is an extension of the move. So look for profit taking, break above 1274 and back below. So basically he's saying they're selling uh, at every level, but there's also momentum. So momentum is running into selling. All right. Downside is 1258.60. So he gives you an initial opening range of 1270.30 to look at and 1258.60. So let's call it 1258.5 and 1270. So that's a pretty big range, but it's justified considering the range we had last night. And these come in probably on hourly trend lines for him. Now, in his macro report, which I'm not showing you, uh, uh, he says that we are in a bullish configuration again. Uh, and these exhaustion levels are the same exhaustions he has in that, but the bullish configuration is valid, and pullbacks are to be bought according to that. So let's talk about get long on a decent penetration above. So if you're a momentum trader, we get above 1270, you're long. All right. Reverse, if we get back below, get out. Depends on where you want to put your stop. Pick your stops based on the amount of money you want to risk, and try and correlate that with the technical numbers that you trust. Get long on a decent penetration of 1275. Well, decent could be meaning heavy volume. Could also mean uh, big ticks. Meaning a lot of ticks. So I don't like those. There's a risk reward. I like them when they're right above and they have heavy volume, but I don't like them when they run decently. But it's a rising. Notice this: 1.2 ticks per hour starting at 8:20 a.m. So that's an hourly chart. So why don't we go to that? See what the rationale here is. Okay. So we're going to make this up, but we think we have an idea here. All right. We're going to say bring the bottom to bottom. And we fix the right hand link so it okay. I think my drop down list is giving me a problem here. Bear with me, guys. Since I changed my screen and hide stuff. There we go. Actually, I think I just missed it. Okay, so there's a trend line. Let's try and draw this on the futures. Another reason I keep the futures down is because I usually have so many uh, lines and studies on it. But okay, that could be his line. This could be his line, but he is looking at an hourly line. Or looking at a line that does something like this. No, I don't think so. Anyway, that is the mystery of his work, and it is good. All right, so you see the technical levels there? All right. Okay. Okay, I am being joined by one of my offspring and his pet dogs. So why don't we get back to the work at hand? Okay, we have a government shutdown. We have a government shutdown that is looking like it's going to continue on. and possibly go through till January 3rd, based on conversations I've had with uh, other opportunistic trader experts that are more familiar with the political situation. Mnuchin had a conversation this weekend with top bank CEOs to discuss liquidity. Now, that may have been part of what was being discussed, but I'll tell you what else is being discussed: the Fed itself. So, to discuss liquidity is to indirectly discuss the Fed, and he made some comments to that effect. And I want to focus on that um, uh, as the jumping off point into Trump's dilemma, or the bad side of his concept. We're going to look at stocks in a second, but gold is higher because of increased uncertainty. Gold is higher because there are more buyers and sellers, and gold is higher because the dollar is weaker. So take your choice. All these things are relevant. Uh, so why don't we tighten it up here? Okay, so I think we should be careful today. And this, I'm going to talk about the stock market for 1 second and try and bring this home more efficiently, because I am joined here as a single dad uh, with my children, and I want to spend some time with them. Um, the stock market is 40 to 45 handles lower from the highs of the session, and those of you who tune into the AM roadmap uh, know that we have pointed out there's an algo that uh, comes in. Well, I think it's an algo. Larry just sees the buying coming in during the thin hours to kind of like ramp the market up before real liquidity comes in. But we're 40 handles lower. So maybe that algo has been turned off for the holiday, or maybe it's failed. I bring that up because one of the things Larry's had on his plate or on his radar is when we have a morning that comes in lower as opposed to higher, because you have like 30 handle moves higher overnight that end up with 40 handles move lower. Be careful, be on the alert for reversal day. So if we come in 30, 40 handles lower today, uh, doesn't mean we won't drop another 40 handles, but we could also do that and then rally at the end of the day. Could be the near capitulation, doing things like that. And the fact that Mnuchin is speaking with CEOs of banks, which comprise members of the Fed, uh, they appoint the members of the Fed or something like that. I'm not really sure, but they're involved in it. Let's put it that way. Actually, I know a lot more than I'm saying. Um, that's implication that they're talking to the Fed about the Fed's policies and how it's affecting the market. So why don't we go to that? Because I think it's a bunch of crap. Doesn't mean I'm not going to give it some credence, but I'll tell you why I think it's a bunch of crap. First of all, the sell-off in stocks is a concern. It's a cause for major concern for a president who chose to measure his success by it. Now, this is politics, but this is about policy. All right. Now, most presidents don't measure success by the stock market. They measure by the economy because they know that the stock market is more volatile than the economy. So when you tweet or make public comments about measuring your success as a function of the stock market, you take great risk. And Trump's the kind of guy who steps out there and takes risk. Uh, uh, love that or hate that, but he takes risk because he actually knows where his stops are, and his stop loss was with Powell. But here's the problem: the S&P has lost 13% since the day of his tariff man tweet. So, if you want to point to the Fed, I'm speaking to as if I were speaking to the president. If you want to point to the Fed as the reason for the stock sell-off, uh, I think you're remiss, and I'll substantiate that in a second. If you want to point to the Fed as a reason for the stock sell-off, you're remiss. Uh, the reason this is relevant to gold is because, by the way, if just to regress a second or digress, if the stock market does reverse higher today, uh, you might not see gold reverse lower because it could be hand in hand with a weaker dollar. We'll come back to that in future sessions, actually. But what I want to focus on now, while I can focus this, was Trump has chosen to live by the stock market and is in danger of dying by the stock market. Now, the tariffs can be just as responsible, if not more, than the Fed. Now, it is true that we have the biggest moves since the Fed. There's no doubt about that. But just bear in mind there are 13 sessions since the tariff man tweet. If you want to put a line of demarcation on it, have been post the tariff man tweet, down 13% in 13 sessions. But now I'll give you the other side of the coin that actually legitimizes the point of the Fed being independent, though not necessarily Trump's timing of his statement. One side of the coin, regardless of the president's poor timing on the issue, is he raises a point about the Fed that ties it indirectly and directly, depending on who you're talking to its ability to, I'm reading from my own notes here, to abuse power and put U.S. banks before U.S. citizens. Now, I'm not saying that Powell is doing that, but let's just take that point of view for a moment. That's what he inherited. But the net effect of QT, just like the too big to fail concept, which was a bailout of the banks, is that Main Street suffers while Wall Street does well. Now during QE, Main Street might have done better, those people in stock market, while banks also. But there's no situation where banks suffer, is what I'm getting at. And banks comprise the Fed, and the Fed is independent. So there's really a good case for saying that the Fed should not be as independent as one says. A good example of that would be, Volcker came in during Reagan. Volcker was independent, but Reagan picked a guy who was going to do what needed to be done to stem inflation. So do you want to blame Trump for his own pick? I don't know, but certainly he had an effect on that. So the net effect of QT is bearish for the stock market. And yes, you are raising rates into a weakening stock market, and people are fighting over cause and effect. But I want to point out the other hand and bring it back to my opinion, which is if we were to give any credence to surveys, then you have to give credence to surveys, especially surveys that repeat themselves in a continuous, so you can at least look at the reference point. Well, there are many surveys, but there's a Bloomberg survey that's midpoint, puts the chances of a recession at 20% in the next year. That is the same as all of 2016 and half of 2017. So think about that. If the chance of recession is 20, 30, even 40% in the next 12 months, but you see other pressures, other data that make you more hawkish, there's really nothing that the Fed's doing wrong. The difference between 2016 and today, at least by one measure, is not the chance of recession, it's the tariffs. So we're beginning to suffer what China has already suffered in a much bigger deal, 20, 30% off the highs. So back to gold for today. I think we should be very careful about gold. Let me put up my stuff today because I think we might have some trades today. All right. First of all, on the hourly basis, okay, gold had an expansion last night from what I would consider unsafe levels to trade, and now we're back in it. All right. On my levels, 1264.5 is a level to not be long below, which is actually consistent with those of you who look at it from a technical basis. And this is important because we are nearing the end of the year. I'm going to put up this, which for me is the holy grail. You want to know where fund managers are trading right now? I'll show you. All right. This is a moving average that I put up many times. And this moving average is an indication of what fund managers are doing. All right, this is a 12-month moving average. It does coincide similarly with 200-day, but you can see where it is here. I don't want you to look at that. I would like you to draw your attention to the month before, where the moving average closed at 1268 spot 88 in continuous Feb 1-month futures. Settlement above that at the end of the month is a buy signal. It's a buy signal, but you have to hold it for at least 30 days. So you risk a lot of downside, but it's a buy signal. And if this yellow line turns up, you'll see some serious momentum. You see it here, okay? And you see it go through here and then flatten, kind of chop around a little bit. And actually, we called this move here, and we called this move, but we also called it to go to 1700, so that was wrong. But pay attention to this, because this number, although it doesn't matter day to day, it's going to matter a week from now. So if you're trading gold from an intraday basis, use the technical numbers that we're giving you, or use your own. If you're looking at gold as something to hold, I won't call it an investment. If we close this month above 1268 spot 88, your average return for the last 20 years has been 3% above that line. Your average return below that line is negative 1.5%. The past doesn't predict the future, but slow moving averages, longer term macro moving averages are where funds play. What I mean by that is when we get below them, macro funds sell. When we get above them, macro funds buy. Here's a long-term buy. There's others back there, but we're just staying here. Here's an example of the market making a low, and here's a chop, right? Goes low, right? So you're losing money below, right? And here's, you get long at this month, right? And you sell that, so it's a scratch, or you would sell it at the end of this month. You can sell it actually at the end of this month. Sell, and then you're still short, and you're going to cover, say you cover here, okay? So these are very important if you're looking for a macro bias to micro trade. I would like to be a buyer of this market on pullbacks. And I'll give you my levels today. I don't think I'll be active today. We did the 1 hour. All right. The 4 hour also gives us nothing. It really does. And that shows that we're in an orderly move higher, uh, which also would imply orderly move higher, which also would imply blow off top before sell off. And on a weekly, we're in the we called to get long on this week, almost stopped us out. We took our profits in here, and we're still moving. You should just be long. If you want to hold it week to week, you can be long with a 1247 stop if you're long from uh, lower levels. I would say get long, stay long on a 1247. Get short or get out of your longs on a settlement below last week's close, okay, which is 1259, or a print of 1247, depending on how much risk you're willing to take. If you're trading on an hourly basis, it's 8:23. I only have 2 more minutes. Uh, Friendly to the market above 65. Unfriendly below 59. Those are my levels today. Uh, have a happy holiday and stay with us, because I think today, although many people won't be watching, will be an important day for the stock market, as we are 30, 40. How many handles are we lower now? All right. So on delay, 23 handles lower in the ES, but the fair value of that I think is lower. So we're looking pretty bad right now. And there's going to be a lot more jawboning about the Fed's independence, the government shutdown. Gold could sell off on a government shutdown too, by the way, guys. But as long as the dollar is weaker, it doesn't matter what the stock market is doing right now, because it looks to me like the dollar is the driver of this market. 20 basis point move lower in the dollar. Actually, that's 0.02. That's a 10-year, sorry. Um, 20 basis point move in a dollar, which is where we are now, is giving you, 26 basis points move a lower dollar, is giving you $7 rally in gold from the Globex settlement. It didn't used to do that. 50 basis point move higher in a dollar used to give us $10, $20 sell-offs, and it still does. But right now, it's really not doing that except for that one day. Signing off. It's 8:25. Merry Christmas. And I'll be back on the 26th, and I'll be joining Larry on the AM Roadmap. Stay with us. If you're in the market, stay. If you're not in the markets, enjoy your coffee, enjoy your families. Be careful.